Good morning and welcome to our retirement readiness series. Today, we're going to be having our discussion regarding compensation packages. My name is John Iaconetti. I'm a financial advisor here with Assante Capital Management. With me today, Mike Connon, Senior Financial Advisor and also works at Assante Capital Management as well. We're located here at the McClelland Financial Group in Thornhill. Today's focus is going to be on compensation packages. This is going to be part one of our multiple part series on retirement readiness. So if you and a couple friends are approaching retirement and have any questions, this is the correct series for you. And feel free to share with as many people as you can. We're always happy to help as many Canadians as we can. Just wanted to give a little notice. We do have some background noise going on with construction, so bear with us if you do hear any sort of background noise. But we'll get things started today with an agenda. So we'll start a little bit about us and what our office does here in Thornhill. We'll talk about the introduction to early retirement. We'll go through a couple different retirement compensation packages and what I guess you could expect if you're leading up to retirement. Number 4, we'll provide a little bit of advice today, just in terms of what things to consider. And number 5, we'll be addressing questions and answers. So here's a great time to reference your screen. We do have a Q&A section down below. And if you do have any questions throughout the presentation, feel free to submit the questions as we go along. We will be addressing them at the end of the presentation. I just want to specify, don't drop any questions in the chat function. We'll only be addressing the questions in Q&A. And a little bit about us. Some of you may already be familiar with the McClelland Financial Group. We're investors in the GTA, and we help Canadians achieve their financial goals. Our focus is using evidence-based investing, creating very strong relationships with our clients, and then also focusing on not being commission-based, but also providing best advice that we can for our clients. So we'll get things started with the topic of today in retirement compensation packages. And I guess the first question is being let go always a bad thing?
Yeah, it's funny. Your fear from when I was a little kid, your fear was being fired. You never would have wanted to go home to your dad and say, "Dad, I got fired from a job," to be the worst thing ever. So it's bred into us that we never want to be let go or laid off in our life. And that's a good thing, but at a certain point, is it always a bad thing? So let's take a look at an example, John.
Yeah, absolutely.
So Joe, he's 63 years old. He's met with us. He's talked about his retirement plan. He said he wanted to retire at 65. So he's worked for this company for 25 years. All of a sudden, if that company comes to Joe and says, "Hey, do you want to take a package right now at 63? Is that a terrible thing?
Yeah, I mean, for Joe, if he's already looking to retire at 65, he might be able to get some compensation leading up to your retirement date.
Well, if you just go and retire at 65, Joe goes the regular route. He waits to 65 and retires. It used to be in the 60s, you get a gold watch, right? So you don't even get a gold watch anymore.
Definitely not.
I think you get like a birthday cake or they bring you out a Moxie's for dinner. That's your retirement package if you go and retire at 65. If the company gives you a choice and says, "Do you want to go earlier?" It's a lot better than that.
Yeah.
So, if Joe is working for this company for 25 years and he's in a, let's say, higher position in that company, he could be entitled to 2 years worth of pay.
Yeah.
So essentially what would happen, Joe can retire at 63, have exactly the same funds as if he retired at 65, but get an extra 2 years in retirement.
Yeah.
How long do people live on average?
Well, it depends. Is it male or female?
Yeah, well, if you go through it, it's around 82 years old, right?
Yeah.
Which what's that put you? 17 years in retirement.
Exactly.
So everyone goes, "Well, what's the difference in 2 years?" 2 out of 17 is a pretty big. And the other big deal about retirement you got to remember is the early years in retirement are the good years. So, we watch clients over the years and they go from, we all call them go years.
Exactly.
Where you're, at 60 years old, you can travel, you can do everything. You get to 70, you're still doing stuff, you're okay. Once you're at 80, it's not that fun.
Yeah.
So, when you talk about those 2 years from 63 to 65, that's a big piece of your usable retirement.
Yeah, exactly. And then it gives you, the opportunity to do exactly what you want to do. It's a good segue into retirement of not having to get into your retirement compensation or deal with any sort of RSPs or anything like that.
So that's why you would take. Why is the company giving this to you?
Yeah, I mean, it's a good question. I mean, from their perspective, it's kind of a one-time expense to let Joe go because they're already starting to think about the next generation, right?
Yeah.
They're already starting to think about new blood, getting new blood into the into the business. And you know, we talked about it before, but new blood also comes at a lower cost.
Yeah.
So the company is letting go of a higher salaried professional and taking on some lower salaried professionals that can grow with the company from that.
It's going to happen anyway. Inevitably, 2 years from now, they'd have to do the switch.
Exactly, exactly. So it could be a good marriage there for Joe, but then also you might be going through something similar if you're watching at home today. So I guess we can get into what types of investments are in your company plan. And there's quite a bit of them. So we'll walk through some of them in a little bit more detail, and some of them may be applicable to you and maybe of benefit for you. And we'll start with group RSPs. And group RSPs might be one of the more easier ones to understand because some of you watching today may have RSPs of your own. A group RSP is essentially pooled accounts from other employees. And one of the main benefits of this that companies offer that might be beneficial to you is it's usually at a lower fee because you have a bunch of companies, a bunch of people applying for that RSP within the company.
The other thing that can happen is within the group RSPs, a lot of times they'll let deduction at source happen because it's coming from your payroll.
Correct.
So what happens, your payroll company will take less tax at source from your paycheck because they know these RSP contributions are being done. So it has an advantage that way. So what happens with a group RSP once you leave the company?
Yep. So group RSP, you can transfer then to your RSP after you leave the company. We talked about it before. They give you that nice fee deal when you're in the group RSP. Unfortunately, after you retire, that fee deal is pretty much gone.
And they do have limited choices because when you're in one of those group RSP plans, a lot of times they're either run by a financial company or insurance company.
Yeah.
And they'll have limited options available. They're getting better nowadays, but they're still limited.
Yeah. Limited options there. And I mean, once you move it into your own individual RSP after you do retire, then you have the flexibility of doing what you like with it. And then when you get into beyond 65 and need to start drawing income, you can convert that into a RIF to get income from it. Next, we have deferred profit sharing plans, or DPSP for short. And essentially, this is like the name implies, a company allocates a portion of their profits towards their employees' retirement. So this will play an impact on your RSP contribution limit. So whatever you get in terms of a DPSP will reduce your RSP contribution limit. And oftentimes there is going to be a vesting period. So the funds that you receive for deferred profit sharing can't just be accessed the next day. There usually has to be a waiting period in there, a couple of years maybe, in order for you to get access to it.
Yeah, I mean, they're a good way to get people to buy into the company. Yeah. Because again, they don't have to be paid out. The company has to have profits, right? So it's based on the profitability of the company. And again, it's a good way to get a buy-in by employees to feel like they have ownership within the company. So what can happen to a DPSP when you go and leave your company?
Yeah, so because it does impact RSP contribution room, it only makes sense then that after you leave the company, you can convert that back to your own personal RSP. And then from there, we follow the same process where it can go to your RIF, retirement income fund, and then you can draw income from it.
Excellent.
Next, we'll take a look at defined contribution pension plans. And this is where employee and employer are both contributing into set accounts. Usually it's a percentage based on your level of income. And these accounts are, the onus is on the employee to choose how they will get invested. So usually when you sign up for the DCPP, they'll give you a list of investment options. You pick the one that works best for you. And that, is once you do your contributions in, we'll be going with the company.
This is the majority of modern pension plans. If you work for a normal company that's non-government, you're probably going to be a defined contribution pension plan. Sometimes they call money purchase plans too, just to put a second name around them. If you do hear that, that would be the same thing. So when you get to the situation, when you leave your company, what are your options in here?
Yeah, so it's going to be a little bit different because you are going to have what your company is put into the plan and then also what you've put into the plan. So what you've put into the plan is entirely your money. It would be considered unlocked, and that can move to an RSP, which can go to a RIF, and then you can generate income from it. What your company's put into the plan, they want to have that money locked in to mimic, I guess, the way it would be if you're still in a pension. If you're still in a pension, you're drawing income and you're limited to how much you can take out of it. Same thing with the locked in portion. It goes into a locked in retirement account and then to a LIF. And then at that point, you have a maximum that you can take out of the account.
So not everyone's retired yet.
Yes.
So let's start talking about, because everyone's been doing RSPs and things like that. No one's been down this RIF road. So let's talk about a RIF and what it is.
Yep. So
And LIF. That's it. Yeah.
Exactly. So a RIF is going to be a registered retirement income fund. So essentially, as you're working, you've been putting money into an RSP. You can convert it to a RIF when you retire. It absolutely has to move into a RIF at age 71. And there'll be a minimum amount that has to come out of that account as income every single year. And it's usually based on your age. So around 70 is probably about 5%, and that'll slowly go up as you get older. You are allowed to list a spouse. So if you do have a very large age gap between yourself and your spouse, and let's say your spouse is 10 years younger, you can list your spouse to get the minimum amount that has to come out slightly lower.
And as you said, you can start a RIF anytime. People get confused. You can start it if you're 20 years old, you can start RIF if you want it. So there's no lower limit to when you can start a RIF. It just usually makes sense when you're retired and you don't have the income coming, because it is taxable. Right?
Exactly. Yeah.
And the locked-in plan. So what's the difference in the locked-in plan?
Yeah, so the locked-in plan is going to be very similar to what the RIF is, where the RIF had a minimum that you have to take out of the account. The locked-in plan is going to also have a maximum amount that you're allowed to take out of that account. So there is going to be a little bit more restriction around that account in terms of what you can take.
It's, again, because that's more of the company pension plan. They want more protection around it.
Correct.
They don't want someone to be able to go out to Vegas and blow their retirement funds. You know, the company's put this in over the years. You blow it at night, then you're in trouble. So that's the reason for that locked-in portion.
Yeah.
Again, one thing that you find when you're talking to advisors now, there's a lot of situations when you're converting your locked in, 50% of many plans can be rolled over to regular RIF. So this is something that gets to be a little bit more advanced strategy. So this is where we always tell people you need planners in your life, because the government came up with this, I think 7 or maybe 10 years ago.
It's been a while.
Not many people do it, to be honest, but it is a very good situation. Take those locked funds and take those handcuffs off it that they have, move 50% into that RIF account, and it gives you a lot more flexibility and options in there. So when you talk with your planner, you should always ask them about that.
Absolutely. The next plan that we'll take a look at is the defined benefit pension plan. Now, this has kind of been the gold standard. Usually when people look for an employer, they want a defined benefit pension plan.
Same situation.
Exactly. Unfortunately, they're not too readily available, I guess, within Canada now. It's primarily been delegated to just government positions like teachers pension plan or Ontario Health. But this is where an employee and employer both contribute into this account. The difference between this and the past pension plan we discussed is that the investment philosophy is all on the employer. So you take away all risk in your hands and it goes directly to the employer. And then what the defined benefit pension plan will do is it'll give you a set amount of income every month until you pass away, essentially, in retirement.
So they put all the risk, essentially the risk is taken away from the employee.
Yeah.
It's all on the employer. That's why they moved to the time where they mostly government run. So we have teachers pension, we have OMERS, we have HOOP. They're all government organizations because they have the backing of the government if something went wrong in there. So that's sort of what happens there. And they are, as you said, the gold standards. Many of them are indexed with inflation, which is phenomenally good.
Yes.
Even the teachers pension plan had to back off that a while ago because it was too much for them to commit to. So I think they're indexed at after a certain point at half the inflation rate. They usually have a formula that's based on years of service. So let's say you've been with this pension plan for 30 years and it's a 2% formula. You get 2% times 30, so that would be 60%. So 60% of your best salary over a 3 or 5 year period.
Yep.
And if you're lucky enough to have one of the government ones, many times it's indexed with inflation, which is it's helped people out massively over the last few years. There'll be all different options. Some have limitations on index. There's all different. Everyone's a little bit different. That's why when people ask you a question, they say, "What's my pension?"
Yeah,
you really have. Everyone is different. Even the government plans are very different. So they're not all the same. So obviously the choice that most people take if you have the golden pension plan is just take the income, right? So that's the one piece. If you didn't want to do that, what's your other option?
Yeah. The other option is going to be taking what they call commuted value. So it's essentially a cash value of the future income that you would have received from that defined benefit pension plan. And when you take that cash value, you have the option of, again, separating it into partly into the RSP, whatever's unlocked in your portion, partly into a locked-in retirement account of whatever your employer has contributed into that account. But Mike, maybe walk through, why would someone even consider doing that?
So there's a few situations where we have recommended it.
Yeah.
Many times if we have two people with defined benefit pension plans, because the one thing about the defined benefit plan is you don't have a lot of choice.
Yeah.
You get a set income, and from a tax point of view, you can't do much about it. So if you have two spouses, sometimes it's nice to have one with that guaranteed income, the other that has the freedom of have that commuted value. That way they control cash flows to when they need them. So that's one option. The second option that we use, if it tends to be, let's say one person, a single person, and they have children.
Mm-hmm.
The one thing about the defined benefit plan is you can pass a survivor benefit onto a spouse, not so much with children.
Yeah.
So if people have children, they want to make sure protected if something happened to them early. A lot of times they'll take the commuted value. That way they can pass that. It would be taxed, but they could pass that asset on to their children.
Yeah.
And I guess what we're talking about, survivor benefits are a big choice to make. When I sit down with people who are about to take the defined benefit pension plan, usually the biggest conversation about survivor benefits. You can take your highest benefit you can take, or the highest payout you're going to have, will have zero survivor benefits. That means if something happens to you,
yep,
your wife doesn't get anything, or your husband doesn't get anything, vice versa. As you go down and you create a higher survivor benefit, you'll take less of a payout on a regular basis, but it means the payout would continue to your spouse if you were to pass away. And, this is one where it depends on everyone's situation.
Yep.
Unfortunately, well, we're both guys, so we know that generally females live a lot longer than males. So if you're a guy taking a pension plan and you have a younger spouse, you want to take that top survivor benefit. You're going to take a little bit off your income that you're going to get on a monthly basis, but that's going to continue, and that's well worth it. If you're in another situation where you have a spouse that's ill or something, that may not make sense. You may want to take the top income coming out of your plan. So that's something you should be sitting down with an advisor to talk about.
Yeah. I mean, that's an excellent point there. I mean, when you think about it, this is why we do these financial plans as well, because just like you mentioned, there's no such thing as a cookie cutter response where everybody should take one option or the other. It's going to be entirely based on your life situation and
it's
the family.
Funny. I always watch these articles that give blanket advice, and they make no sense because every situation is so different.
Yeah. Continuing along, one of the other compensation options that you have for your employer is going to be an employee stock purchase plan. So this plan is going to allow an employee to purchase stock of the company, usually at a discounted price. And these contributions or these purchases are going to typically be made with after-tax dollars. Now, there could be some degree of employer matching that goes along with it. Usually contributions you make or purchase of these shares will be matched by your employer. And similar to the deferred profit sharing plan, there's often a vesting period. So essentially what that means is you can't just purchase these discounted stock and then sell them the next day and take the funds. They won't allow you to do that. It usually is going to be a couple of years' time before these stocks officially become yours and you're fully accessible. And because they come with after-tax dollars, typically they're going to be invested in an open account, but some options do allow for RSPs and TFSA contributions as well.
Yeah, and essentially the conversion path of those is it goes from the shares, you're going to go to an open account, and then you can create income plan from that open account.
Yeah.
Some people will get, a match program, other people will get discounted.
Yep.
They're all different, none are the same. And as you said, some will be open, some will give you an ability to put some in an RSP if you have room, some in TFSAs. So again, it's very hard to give a blanket solution because every company is very different in how they do that. They work very well. One problem with them sometimes is we've had clients in the high tech industry that have been there for a long time. It's become an incredibly large part of their portfolio. So that's something you have to watch, is just your risk of having one position. We don't like to see one position over 10% of someone's portfolio.
Yeah.
It gets to be dangerous. So you got to keep your eye on that. So sometimes along the way, you should be taking those shares and putting them something that's more diversified.
Yeah. I mean, we've always heard it from clients, the degree of confidence that they have in their company. The share price has always been doing well. It should continue to do well, but we've seen the other way happen also, right?
We lived through some times where great companies had bad endings.
Correct. Yeah. So why take that risk? And then the last one here is going to be stock options. So this is going to be very similar to the employee share purchase plan. But essentially, it's the right to acquire shares of a company at a predetermined price at a future date. So it's going to be, that's the only real difference there. It's going to be at a future date. So it's going to be a little bit more down the road compared to the employee stock purchase plan. And it gives you the option to exercise your stock options at that time and to realize how that's taxed. Now, there's a couple different rules around it that maybe we can get into detail on it.
You know, there was a change in July 1st, 2021. We say they're capital gains. It's not really a capital gain. They give you a credit on the return. It makes it treated like a capital gain, essentially, where 50% of the gain is taxable. But after July 1st, 2021, they gave a limitation to $200,000 per calendar year. I guess what they were trying to do is control the corporate executive packages, because a lot of people, instead of taking pay, were taking executive packages that were based on stock options, and they're getting favorable treatment of these massive stock options that would be worth $1 million. They didn't think it was fair that they're getting these, and they were being taxed as a capital gain. And again, this counts for Canadian controlled corporations. So, and there's revenue, there's a lot of details in this. This is one where you should actually get your accountant involved in this, because the taxation treatment of this is not simple. And again, you have people who work for a US company. It's a totally different thing. So this is where you may need some outside tax advice. Yeah,
and especially something that's such a relatively new rule within the last 3 years, it doesn't hurt to have that extra professional advice. But we walked through a bunch of the different options, and here's a pretty good summary, a good visual of it if you are a visual learner out there. And if this is something that maybe you want a copy of, feel free to reach out to our office. We're happy to share this with you. But if you look there at the top line, the defined contribution pension plan, the two arrows that stem from it is where the funds would be transferred upon retirement. So anything in a defined contribution pension plan, whatever's locked would go to a locked-in retirement account. Whatever's unlocked would go to an RSP. The next line there, the defined benefit pension plan, those two arrows are pointing as well. Portion will be locked, go to a locked-in retirement account. Portion unlocked goes to the RSP. For the group RSP and deferred profit sharing plan, both would be directed towards an RSP because both have impact on your RSP contribution room. And then the last two is the employee stock purchase plan or stock options. Those are with after-tax dollars, so those can move directly to an open account. Once those go into your own individual accounts and you want to start generating income, anything in a locked-in retirement account goes into a LIF, life income fund. Anything from an RRSP goes into a RIF, registered retirement income fund. And then the open account is open, so you're allowed to just generate income from it directly.
Yeah, sometimes you may see with Learys, you may see things called locked-in RSPs. Very similar, a little bit different in a few little rules, but small. And those locked-in RSPs goes to a locked-in RIF. So there's a little, but they're basically almost the same thing. And is all the income from these different sources treated the same, John?
No, they are not. So that's where things get a little bit more difficult. You want to make sure that you're speaking with a professional to figure out the tax efficient income that you can generate from that. The LIF and the RIF are going to be entirely taxable as income. So when you generate income from that, whenever you make a withdrawal out of that account, you can withhold tax on that. At the end of the year, you're going to get a T4 from your institution, essentially showing the amount of income you've earned, the amount of tax deducted, and the net amount to you. The open account is a little bit different. So it's a little bit more tax efficient because you're essentially going to be paying capital gains, which obviously have the 50% inclusion rate. You'll pay tax on dividends, which you get a little bit of a credit from the Canadian government. So it's not quite as high. And then a little bit on interest, which is taxed.
So you get T3s, T5s, T5 zeros or 8s off that open account. And, you know, where Canada is the highest tax country, or one of them in the world. I think there's one or two that may be.
Feels like we're the highest.
Yeah, it feels like we're the highest. Anyway, from living here, I feel like we're the highest. So to ignore this is silly, because this is probably the most concentration you should put on things is just when you're getting your income, to make sure investments will go up and down and do what they do. But taxes, if you can save $1 in taxes, it's $1 saved in your pocket. There's no risk in saving $1 in taxes by doing things the correct way. So sometimes I look at what people do, I go, I can't believe they're doing that. It just doesn't make sense. There's marginal tax rates that you have to understand those break points and make sure you're taking advantage of those lower tax rates, because we do have a reasonable tax rate up to certain amounts on the lower tax rates. And many times people can control their retirement income to be very tax effective. And people that don't end up just giving money away to the government.
Yeah. One of the things that a lot of pre-retirees don't think about is old age security clawback. So old age security is essentially a government benefit that you'd receive. But if you go over a certain threshold of income, right, roughly right now about $90,000, they'll begin to start taking away the government benefit. So essentially it becomes like an additional tax for every dollar you go above, there's an extra 15% taken away.
And I mean, other things beyond this would be income split between spouses,
Yep.
things like pension income is split is so you can
Correct.
control, because everyone has an individual tax rate, but you can split these incomes. And again, when we talked about reasons to take defined benefit plans, sometimes you have two spouses with two defined benefit plans, you lose all your benefit, you lose OAS security, you lose OAS and everything. So sometimes if you can work those where you have both options, you can create a more efficient income.
Gotcha. So a couple action items for you watching at home today. First one I'd say is evaluate your options. So assess which plans apply to your situation. Maybe you had a couple of these different retirement plans available to you. It's important to understand what your plan is going to be going forward, because now we've got to start thinking about strategizing the transition of those funds into suitable retirement accounts for you. And at the end of the day, consult advice, seek professional advice tailored to your specific situation, because we talked about it in general today. For you, it might be very different from the person you sit next to at work, right? Everyone has a very different situation, whether it be family-wise, tax-wise, or what have you.
We're doing these seminars because we realized we deal with a lot of people going through this situation.
Correct.
And it's like a deer in the headlights.
Yep.
And we do this all the time, which is great because we're very used to it. And we realize it's very automated for us to be able to figure out how to do this. It's very complex. And you shouldn't be expected to understand everything. And you need help.
Yeah, exactly. And you alluded to it perfectly, because we do have an upcoming webinar on taxation in retirement. It's going to be with you again, Mike, and then also Rob McClelland joining you for that discussion. And that is going to be on Tuesday, September 10th at 11 a.m. The registration link is actually being added into the chat for today. So if you are interested in hearing a little bit more about taxation in retirement, feel free to log into that one. Or if you do know of anybody else that maybe this may be beneficial for, you can feel free to share that registration link with them as well.
And this is being recorded too. So again, you can come to our website afterwards and it will be distributed. So if you have any friends to share this with that are in a situation where they may be, coming up to retirement time, it's a good time to share it with them. Absolutely.
With that in mind, I just want to let everybody watching today know that at the McClelland Financial Group, we're currently offering a free transfers campaign. So our main objective is to try to simplify lives as much as possible. And as we get closer and closer to that retirement period for each of you, if you're looking to transfer those accounts over to Assante, we'll cover all the transfer fees. It's usually about $150 plus per account. So feel free to email us at teamfg@assante.com. And with that in mind, we do have some content that we do get sent out to you. So myself and Carlo, we have Ask Team FG, our YouTube videos talking about similar conversations like this. And then Mike, you have your podcast.
Think Smart with myself and Rob McClelland, just covering current topics and issues and just the things we got our Tim Hortons conversation. We used to go to Tim's and talk about all things that would go on. And we brought that to a podcast and just to keep people up to date what's going on in the world.
Yeah, absolutely. But we've officially made it to the question portion of the presentation. So I see we have a couple questions already beginning to get filtered in. I do want to remind you, if you do have questions, the Q&A section, please drop the questions in there. But we'll get things started with that Q&A section. And the first question that we have: is there any taxable implications of transferring retirement plans into individual accounts?
Well, whenever you keep it in the retirement and the RSP, sort of going from something that's work in a registered account to something that's somewhere else in a registered account, they all transfer with no tax implications, as long as they stay under that registered umbrella. And the institutions do it between them. So we send out certain forms to that institution and they keep it under that registered umbrella and there's no tax implications.
Yeah. What in particular, maybe about stock purchase plans, if those are going to be after-tax dollars and open accounts?
Stock purchase plans, well, again, there's going to be capital gains depending on what they were purchased at. Some of the cases there'll be capital losses actually. So
that's true.
It depends on the situation. So that's one you have to actually go and get your adjusted cost base or book value on the share questionnaires, bring it to your advisor and come up with a plan. A lot of times we'll start to trigger these gains once the person has retired, because once that package goes, again, their tax bracket will go from many times 54% down to 20%.
Yeah.
So why would you trigger those capital gains in a 54% tax bracket when you can wait 6 months and trigger them in a 20% tax bracket?
Exactly. Again, one of the things that I don't think a lot of people think about, they just hear they're getting their stocks. Now it's time to liquidate. You got to think about when you're going to be doing that as well. The next question we had, what would be a good severance package if I worked for a company for over 20 years? And when would you recommend speaking with an employment lawyer?
What I always find is someone who's in just a worker position usually gets about 2 weeks per year.
Yeah.
Once they start to move into management position, it can move up to 4 weeks a year. And it's all, I guess it's always good to speak to a lawyer because they'll help you out, let you know where that is. And that's, my own experience from what I've seen. When people with companies for a longer period of time, they do get better packages. And the bigger companies aren't afraid to pay out. And a lot of time the first offer is not the best offer. So sometimes they'll give an offer and it's time to go back. You don't have to always accept their offer. You can go back and say, here's some other things I want. Other things to consider at the time: medical benefits.
Yep.
Right? Because how long those are going to continue for, when the payout's going to happen, if it's going to happen as a lump sum of this year, where it's all going to be the 54% tax bracket,
Correct.
or if you can get this paid over a few years and keep it in, take advantage of your marginal tax rate. There's a lot to consider. Again, this is a time where you need to be talking to a professional, your advisor, and sometimes a lawyer, to make sure you get the package you deserve.
Yeah. A very good point that you made about specifically when you receive that benefit. If it is going to be lump sum in a year that you're working, you end up losing half of it, more than half of it sometimes. So that's always up for negotiation with your employer. So something to consider. And at the end of the day, I mean, looking into an employment lawyer, if it's going to be such a significant payout to you, it doesn't hurt to get that extra second opinion as well. Another question we had here was, what would be the most important factors to consider to take a commuted value? I'm assuming this one's going to be about a defined benefit pension plan. So want to touch on that again?
Again, we talked a bit about it. So it depends, if number one is, we keep on talking, not all defined benefit plans are from the government.
Yeah.
So if they're not from the government, the first thing to consider is the company.
Yeah.
We had clients with Nortel, they didn't get their defined benefit plan. They got a percentage of the defined benefit plan because the money wasn't there. So start off with that. Is your company 100% safe? Because why take the risk on a single company?
Yeah.
It doesn't make any sense. You'd rather have the money in your hands and be able to diversify that risk rather than have it one company.
Correct.
They say everything's supposed to be kept separate in pension plans, but Nortel didn't work that way. I think Kodak didn't work that. I've seen a bunch of companies over time, when things went badly, they didn't quite work that way. So that's number one. Number two is the situation with your spouse. If you both have defined benefit plans, cash flow, how you can control that. Again, when you take commuted value, you have control of your cash flow. From a tax point of view, that can be a really good thing. And the next thing is just survivor. If you're anyway ill and don't have a spouse that can, if they don't give you the ability to pass a large amount over to your spouse, a lot of times you're better off just taking that money, have the commuted value. If something were to happen to you, your spouse gets 100% benefit because there's no taxation between it. So again, that can be a situation, or if you don't have a spouse and you want to make sure that maximum is passed on to your kids, that can be another situation where you do take those commuted values. So it's, again, there's a lot of reasons why it might happen. I do like all the teachers' plans and all those plans. I think they're great.
Yeah.
But there are situations where it doesn't make sense to take the cash.
Yeah. Specifically indexing, taking that into consideration as well. I mean, you end up receiving $60,000 a year this year. That's great. But if you're not keeping up with the rate of inflation, you're losing purchasing power every year.
The other thing that people forget is that the better the pension plan, the higher the commuted value is going to be. So, you get a teacher's pension plan, they can be worth over $1 million in commuted value because they have index and all that is formulated to give you a break even. You should be, a commuted value is exactly that. It's commuting the value of that cash flow in the future to a current dollar amount. So that's the definition of a commuted value. And they have to use standardized factors. Commuted values were very high in the past few years because we're working on a low interest rate. And that gave high commuted values. As interest rates get higher, they're using long-term interest rates. As interest rates get higher, those commuted values come down a bit.
Perfect. But that was, those were the questions we had for today. If you didn't get the opportunity to ask a question or wanted a little bit more detail, you could always feel free to email our website, our email at teamfg@assante.com. Or feel free to reach out to Mike and myself personally, and we'll be happy to get back to you. But that was part one of our retirement readiness series.
We look forward to seeing you for part two.
Exactly. Part two will be coming up in September. You already got the registration link down in the chat, so highly recommend you get registered for that, because it's going to be a great conversation with Mike and Rob. As always, I mean, if you ever have questions, you know where to find us. We're always happy to help. Down below is our phone number, 905-771-5200, or visit our website, www.teamfg.ca. Otherwise, wishing you all the best today. And as always, if you ever have questions, you know where to find us.